Hello, my name is Stephen Bates, CEO of QLab Invest. In a previous video, I explained the behavioral biases that we can all suffer from when we invest. Now in this 5-minute video, I want to explain how you avoid the resulting psychological traps to achieve peace of mind investing, remove the worry, and stay invested through the market cycle. Scientific research has revealed a few interesting properties of financial markets. 1. Markets exhibit repeating cycles linked to investor herding, greed, and fear. 2. Risk is somewhat predictable in the short term, just as following an earthquake, risk in financial markets stays high after a shock before declining again. 3. Momentum effects due to herding mean steady trends up or down can persist for some time. 4. Stronger market corrections can happen at any time, which means you need a robust and independent risk management process. And lastly, investment processes should be highly disciplined, ideally systematic, to avoid getting caught out by your emotions. Let us see how this knowledge may be used to manage an investment portfolio. This chart shows the 1-year returns of 4 asset classes over the last 30 years. The assets are US equities, a broad set of commodities, US Treasury bonds, and a basket of currencies against the US dollar. I pick these assets because they are diversified, highly liquid, and cheap to access. Firstly, you will notice there is a strong bias to positive returns. This is evidence for the so-called risk premium, and proponents of the efficient market hypothesis say that this return is a free lunch, and all you need to do is to invest passively and relax. However, the grey shaded areas highlight the periods when an asset declined for more than a year, showing that this can be far from relaxing. For example, if you equally weighted these assets and passively invested, the return was 4% in excess of cash per year with 8% volatility, which isn't too bad. However, the worst drawdown, or peak to trough loss, was over 30%. This level of loss can cause people to panic and pull out of the market, missing the recovery. When emotions take over, sudden decisions are often made at the worst time. Actually, that's not passive at all. You will also notice that on every occasion an asset declined, at least one asset increased in value. This is the result of investors moving their money around looking for relative yield or relative safety. So the role of the active manager is to treat these assets as competing and periodically change the allocation to favor the better performing assets and avoid the worst performing assets. Let's look at the results of such an asset allocation process. The first portfolio is the market portfolio of the 4 assets plus cash, which I call the naive portfolio. This is the approximately equally weighted investment universe rebalanced monthly, as shown by the fact that each asset weight does not change over time. Actually, this portfolio is not strictly passive. The asset weights are rebalanced back to their target values monthly. This is a technique which improves risk-adjusted returns and is thus a harder target to beat. The performance of the naive portfolio is shown by the blue line, which compares well to the S&P 500 due to the higher diversification. However, you can also see the rather large loss of about 30% that occurred at the end of 2008, but at least it was less than the 50% loss in the equity market. The second portfolio is active, with the aim to steer allocations into the best performing assets and away from the poorly performing assets. You can see that occasionally there is a movement away from certain assets, for example exiting equities, shown in red, during the technology crisis in 2001 and the credit crisis in 2008. Similarly, during the interest rate hike period in the mid-2000s, there was a movement out of US Treasury bonds into cash while they performed poorly. There is no shorting involved, just reduction or complete exit of an asset. The performance as shown by the grey line is much smoother as a result. Here, the performance of the 2 portfolios is compared. The naive portfolio delivered an annualized return of 7.5% with 8% volatility. But here in 2008, this large drawdown of around minus 30% is due mainly to staying invested in equities through the credit crisis. This is the point a passive investor may have panicked and sold. The active QLab asset allocation strategy, however, managed to avoid this drawdown by exiting equities and also commodities for a while. The resulting annualized return was 2% higher at 9.5% per year, with a lower 6% volatility, and more importantly, a worse drawdown of only -7%. Certainly an easier ride on the nerves, meaning the investor is more likely to stay invested and benefit from the whole market cycle. This final picture shows what I believe is most important: the rolling returns of the active strategy versus the naive strategy. On the left-hand side, returns stay positive in the active asset allocation strategy when negative in the naive portfolio. And on the right-hand side, when the naive portfolio performs well, the active strategy also does well. Essentially high correlation when markets go up and low correlation when markets go down. This property is called convexity and is a result of the effectiveness of the robust risk management and systematic asset selection. People often comment it is not possible to beat the markets. What I believe is important for the investor is not beating the market continuously, but simply keeping up with the market when it goes up, and only beating the market when it goes down, thus generating convex returns. This removes a lot of the worry from investing and gives the investor the peace of mind to stay invested throughout the cycle, which is the best way to pick up the risk premium and grow wealth over time.